Good afternoon. Welcome to Midcap Radar. I am Reema Tendulkar. With me is Ekta Batra, and these are the top stories that we're tracking at 1:30 p.m. today. Stocks recover sharply after an early intraday dip. The midcaps are underperforming, now in the red. Financials, auto, IT lead, while the healthcare and realty are under pressure.
Consolidated buzz and news flow continue to drive moves in the mid-cap cement space. Nuvoco and Sanghi Industries gain. Large cap peer Ambuja Cements board approves a preferential issue of convertible warrants to Harmonia Trade and Investment, while Adani Group sets itself a target of becoming India's largest and most efficient cement maker by 2030.
Escorts Kubota hits a fresh 52-week high on a board nod for the merger of Escorts Kubota India and Kubota Agri Machinery India into itself. Expect the joint venture to be profitable in FY24. The management tells CNBC-TV18 it expects the merger to boost the sales.
McLeod Russel continues to be locked in its 20% upper circuit as news of a takeover bid by Carbon Resources. Private Carbon Resources tells CNBC-TV18 it has submitted a non-binding LOI to the lenders of the debt-hit tea maker.
Adani Wilmar gets set to expand its ready-to-cook range. The management tells CNBC-TV18 the company will leverage the recent acquisition of Kohinoor and launch several products under this brand.
Okay, so those are all of the top stories that we're tracking at this point in time. For the markets, the mid-cap index is really flitting between red and green. So the mid-cap index is now down around 0.2%. The intraday chart will tell you about the zigzag moves that you can see for the broader markets, but nothing really to write home about. Maybe there is a worsening which has taken place in the advanced decline ratio. Just an hour back, it stood at around 1:1. So it has worsened to around 1,750 stocks advancing to around over 1,900 stocks declining at this point in time. But let's talk about a couple of companies then. India Pesticides is one company which is in focus. The company has commissioned its first phase of the backward integration for Prithvi Kalor Technical with 2,000 tons per annum capacity in the first quarter. To discuss the demand outlook, inflationary pressures, we have with us Dheeraj Kumar Jain, the CEO of India Pesticides, joining in now. Mr. Jain, hi. Thank you very much for taking the time out. If you could just go through this capacity expansion that you've undertaken, I would assume for one of your key products within the pesticide space. Tell us what this means for business because of the kind of demand you might be servicing currently.
Thank you. Good afternoon to all. We have recently undertaken the expansion of one of our herbicides backward integration. The intermediate was largely being imported into India. So taking a clue from there, we have recently commissioned this plant of 2,000 tons per annum capacity. And we see that we should be able to utilize this capacity fully. And there is a great demand of this product in India. It is a very important rice herbicide. And the total demand in India must be almost about 8 to 10,000 tons. So we are catering, we are planning to increase this capacity also by next year, taking the experience from this present plant.
How soon do you think you will be able to achieve full capacity, 100% capacity utilization? And what is the full revenue potential of this 2,000 tons?
The 2,000 tons, the revenue potential is almost about 90 to 100 crores, ma'am.
Okay. Okay, and how soon, sir, do you think you will be able to achieve full capacity utilization?
Full capacity utilization, we should be able to achieve in coming 3 to 4 months.
3 to 4.
Okay.
We are already commissioned, the plant is running in good condition. And because presently the season for rice is slightly low, but as it catches up by December, January, we will be achieving the full capacity.
Okay. Have your exports taken a hit globally simply because of the kind of situation we are facing in Europe with the gas supply issue, fears of recession in the US? Has that impacted contracts globally?
No, we have long-term contracts globally with major companies around the world. And we are able to, we don't get, up till now, there is no problem on us for any supply constraints. We are getting reasonably good orders from all the customers. And Europe situation slightly it is getting the situation there is dry now, so there could be a little bit of problem, but we don't think we will be getting affected on that count.
What were the exports in FY22 and what do you think your exports will be in FY23?
Our export will be, madam, almost about 50% of our total revenue. And that would be again in the range of almost 250 to 300 crores.
Okay, so you expect your exports to be around 250 to 300 crores. But margins have been a problem for most companies within this space, and that was clearly an issue for you in the quarter gone by. It came down to around 26, 27% versus say over 33% same time last year. So tell us how exactly is this situation panning out when it comes to input costs for you, and what is your margin guidance? Even a range will do.
Yeah, madam, actually what is happening, the raw material prices, they have been changing a lot. There has been various reasons for this. And though we are able to pass on to our customers the raw material cost, but the other manufacturing costs, because of the high inflation and especially increase in the energy cost, that needs to be passed on. So that's why there was slightly reduction in the margin. But we expect a margin of about 25 to 27%, rather 26 to 28% range margin would be there.
So similar to what we had in Q1. So margin should sustain at the current level. You also spoke about expanding your capacity next year. So currently, I think you've commissioned 2,000 tons per annum, but you're contemplating a further expansion. Could you give us details?
Yeah, actually our capacity last year was 19,500 metric tons of technical. We have expanded this capacity to 21,500 by the end of March 22. And then again, we added 2,000 tons recently with our backward integration. That's what we already told. And we would be increasing the capacity by another 4,000 tons by March 23. By adding one more intermediate, which is again largely imported.
Okay.
And apart from this, we have already bought under our subsidiary, 100% subsidiary, a piece of land near Kanpur of about 25 acres. There we are going to expand the further project work. And we have already applied for the environmental clearance for that, and we expect that maybe in a month or two, we should be able to get the environmental clearance, and we will start working there, and we would be doing a capex of about 100 to 125 crores for the next 4 years.
Okay. Just quickly then, you know, in terms of revenue, if you just extrapolate how you did in Q1 and based on your growth that you've seen, say, FY22 versus FY21, you're probably online or on track to do 800 crores in terms of revenue?
Madam, revenue, it will be, last year we did 729 crores. And this year we would be expanding at least by 25%. And the coming 3 to 4 years also we see a growth of almost 20 to 25% range.
Mr. Kumar, we'll leave it at that. Thank you very much for joining in. That's India Pesticides guiding for a 20-25% revenue growth this year and margins between 26 to 28%. They've also got some capex lined up over the next 4 years with an investment plan of about 100 to 125 crore. But let's move on. Carbon Resources Private is looking to take over McLeod Russel. Details on this story when we return.
Welcome back. Well, it is definitely a resilient market at this point. The bank nifty is up around 0.4%. We have the nifty, which is up around 0.5%. We have a lot of central bank meets which are coming up. And the big one obviously would be the Fed meet, and followed by the Reserve Bank of India, which would be meeting at the end of this month as well. But let's concentrate on a particular stock, McLeod Russel. Carbon Resources Private is looking to take over McLeod Russel and has in fact submitted a letter of intent to the lenders, which CNBC-TV18 has accessed. Vivek Iyer, who's been following this story, has the details on it. Vivek.
Well, that's right. So the stock in focus is McLeod Russel, and it appears as though a very large deal is brewing in the Indian tea market. So a company called Carbon Resources Private Limited, that is involved in the production of calcined petcoke, CPC, mainly used in metal industries, is looking to diversify into non-core businesses, and it appears, and we have access to this particular LOI that the company has submitted to the lenders. In this particular LOI, the company Carbon Resources Private Limited has marked it to SBI Capital Markets and ICICI Bank, and they have offered a holistic solution as far as the debt resolution plan of McLeod Russel is concerned. They have offered almost 1,245 crore towards almost 1,650 crore worth of outstanding debt that McLeod Russel continues to owe to the lenders. So this particular deal, Carbon Resources has proposed that they would be funding this particular deal via 300 crore of equity infusion and 945 crore of new debt that they would be taking on their own books. Now, this particular deal could be quite important given the fact that McLeod Russel continues to remain a very important developer as far as the Indian tea market is concerned. Also, Carbon Resources, in order to show very clear strategic intent, on Friday had picked up almost 49.5 lakh shares via NSE, and we understand that a further stake sale was done, a stake buy was done on the BSE as well. So with this particular stake purchase, they would be owning over 5% stake, and this would propel them to amongst the top 3 shareholders as far as McLeod Russel is concerned. We reached out to all of the concerned parties. Carbon Resources came back to us. They confirmed the CNBC-TV18 exclusive. They said that we have presented a non-binding LOI to the lenders of McLeod Russel.
Vivek, thank you very much for getting us those exclusive details. Prakash Diwan is also here joining in to tell us what we should do. McLeod Russell's stock has been locked in an upper circuit of 20% for 2 consecutive days. Prakash, your thoughts on this transaction which is brewing?
So, Rima, good afternoon. So I'm not too sure whether you could do anything today, but let me just allow me to put this in perspective from a historical or anecdotal standpoint. It's been a couple of occasions in the past that people have tried acquiring a controlling stake in this company, but somehow, whether it was the Burmans, whether it was the Sanjeev Goenka group, but nothing fructified at that point in time because the promoter shareholding is itself very fractured. Now, given the fact that most of this leverage that has been built into the books of the company is primarily because of a lot of expansion into a non-related real estate business is what got them, into this pit of sorts. Now, this whole, interest burden that's been accumulating over the last many years is what actually has caused a lot of issues, whereas the company's top line growth or revenue growth, if you see, and especially, if you look at the last year, the FY22, FY23 numbers, they're fairly decent. It's grown. It's still losing money given a lot of the debt issues and the interest burden that it has. But some of the subsidiaries are invaluable in terms of what they could contribute. So I think as a company, it's asset rich but cash starved. So that's where the problem is. If this goes through, I'm not too sure whether Carbon Resources is a great play in terms of managing the tea business, because they are into, as Vivek explained, they're into the electrode powder business, which is slightly divergent from the tea business. But whoever takes majority control and pays off the debt could very easily revive this company. I mean, otherwise it would take organically many years to happen. So I think if this goes through for existing shareholders, it's definitely going to be a very big positive. But then the stock has flattered to deceive in the past. It's had these wild moves and lost ground as well when things didn't fructify. Hopefully this time something will crystallize.
Okay, all right, Prakash. In fact, the debt to equity as of FY22 stood at around 1.27 times versus 1.26 times in FY21. So it's not really moved too much. But Prakash, would you recommend to your clients to probably buy into this stock? It's already at a 52-week high. Do you think that it could probably move up? This is a sustainable trigger?
So, Ekta, interestingly, if you do a little bit of a rough back of the envelope calculation in terms of the assets that it has, and comparably with some of the tea businesses globally or even within India, it definitely has a lot of value. You could come anywhere between 70 to 80, 85 bucks on the price of the stock, the fair value of the stock, provided this debt burden, as you mentioned rightly, eases off, and that's not a drag on the balance sheet. But I think as a recommendation, the interesting part would be to see how close Carbon Resources is to converting this from a LOI to a concrete proposal, and which the lenders like to take up. But the numbers look pretty interesting on the proposal itself. I mean, the haircut that the potential acquirer is looking at making the lender stake is not significant as compared to some of the other deals that we've seen. So it could possibly go through with that attractiveness. And if it does, it definitely makes for some sort of value discovery or some sort of a up move. But it's a small company, 350 odd crores market cap. They're always very vulnerable. So depending on the risk appetite of the investor, you would have to evaluate. But I do see some value in terms of from where it is to where it could go, given the asset-rich balance sheet that it has. So yeah, interesting stage it is at. But I think it would depend on the individual risk reward to take into such a small company with a potential upside that's kind of very clearly building up as per this story that you've broken.
Prakash, thank you very much for joining in. And perhaps also this economic crisis taking place in Sri Lanka, which has been a large exporter of tea, also opens up opportunity for the Indian producers of tea, particularly in the category that Sri Lanka operates in, the orthodox tea, as it's called. So perhaps that's also an opportunity for Indian producers. We'll get into a break on that note. On the other side, we'll put the focus on footwear companies and tell us what's driving the space. Stay tuned. Welcome back. You're tuned into Midcap Radar on CNBC-TV18. This is our special Midcap Spotlight segment. Mangalam is standing by and he's going to be putting the spotlight on footwear companies.
Well, as far as the footwear space is concerned, there is a report coming in from Motilal Oswal this morning, and they believe that, the organized branded players in India's footwear market are likely to grow 1.5 times the overall industry itself, and that is what spiked their interest in this itself. We have around 4 listed footwear companies which Motilal Oswal talks about. Metro Brands, over the last 10 years, they've shown consistent double-digit revenue as well as profit growth. So that is something that they like, apart from the fact that, the recent brand tie-ups that the company has done with a few third-party companies should do them well going forward. So they factored in a revenue and a net profit CAGR of anywhere between 31 to 37% over the next 3 years, and they've valued the stock at 50 times FY25 PE, initiated coverage with a buy and a target price of 1,000. The other one is Campus that they talk about. That's the other stock which is buzzing around in today's trading session. The thing for them is that it's a vertically integrated manufacturing ecosystem. They tend to benefit from 2 things. One is the premiumization push, and the second is the tectonic shift that is taking place towards the sportswear category, which will benefit the company. And because it's been expected to grow faster than the industry, they're valuing the stock at 55 times FY25 price to earnings. They too have a buy rating on this one with an initiating target of 640 odd rupees. Bata is India's largest and oldest footwear retail brand. The management has aggressive plans to expand their footprint despite being the largest here, and they have a target of almost 5,000 to 5,500 crores in terms of revenues over the next year. But because of its size, they valued Bata at a 25% discount to the footwear universe, and they have a neutral rating on that stock, and that's why that stock is mildly in the green. And finally, we have Relaxo, which is the dominant player in the open footwear segment, which is basically slippers, etc. There is a fair amount of competition, especially given the volatile raw material prices. So they ascribe a price to earnings of 60 times because the stock is already trading at 80 times. So the key risk out there is high valuations, and that's why they have a neutral rating on Relaxo footwear. That stock mildly in the red today.
Okay, interesting data there. Thanks, Manglam, for that. But just watch out for CEAT because that one is seeing an up move again. So buying coming in at higher levels for CEAT, up around 7% at this point in time. Remember, it's a complete rank outperformer. Month to date, it's given returns of 20% plus and year to date up 40%. But talking about the same space, Schaeffler is in focus this time round for negative news from the entire OEM space. Kotak Securities has downgraded the stock. Rima, tell us more.
They've downgraded Schaeffler India to a sell from an add rating. The target price is 2,600, which means significant downside from where the stock currently is. The reason is they're saying that the strong growth in the medium term that the street is anticipating is already priced in. And second, valuations at 52 times forward multiple FY24 PE, it's expensive. They're saying that while the exports business of Schaeffler India is looking good, at the current price, the street is pricing in a near 19% revenue growth for the domestic business over the next 15 years, which according to them is very challenging. The organic revenue growth for the company has only been 8% over the last decade. So now to anticipate a 19% domestic revenue growth, over the next 15 years looks too optimistic for them. They're also saying that 75% of its revenues comes from the auto OEM and replacement segment, where the industry growth is expected to be about just 7 to 8% over the medium term. So where is the 19% domestic revenue growth going to, come from? So that's the reason why today Kotak Institutional Equities has downgraded Schaeffler India target price 2,600, which means a significant downside from where the stock currently is, and it's already down 5% today. Well, with that, we're out of time on Midcap Radar. Thank you for watching Inside Out. When we return.